So today we are going to continue on talking about chapter 4. Let's see here. I did add some agenda items. So this is what I put up, what we discussed last week. Just kind of did a little summary so that to remind you of what it was that we covered in class. So today we are going to continue on with this. I do have a little video just to kind of give you a little bit of history about income tax. As many of you know, taxes are one of the reasons that this country was founded. Remember the Boston Tea Party? That was all about taxes. Not the only reason that it was founded, obviously, but it had a big impact on the formation of this country. So we have a long and storied history with taxes. Income taxes, though, that wasn't an income tax. That was a tax on tea. It was an excise tax. Income taxes, though, actually weren't introduced in this country until about the late 1800s or so. Taxes seem to always be introduced in conjunction with war, right? Funds are needed in order to fund wars. And so the Civil War saw the first income tax. It kind of went by the wayside after that and then was reintroduced in the early 1900s until we actually had the amendment to the Constitution, which allowed the federal government to collect income taxes. So, and for a long time, until World War II, income taxes in this country were collected on an annual basis. You filled out your income tax form at the end of the year and you sent in your taxes that were owed. Well, it's awfully difficult to collect from people if they, at the end of the year, if they haven't set that money aside. Well, and the federal government needed funds more frequently than that. And so it was in conjunction with World War II that we started instituting the withholding from incomes to collect those taxes. And that's what we're most interested in this class, is that whole process. The other side of it, the actual collection of taxes and reporting of taxes on an annual basis, you'll get to learn all about that when you take income tax accounting. But for our purposes, it's that withholding that we are mostly interested in. And we will talk a little bit, though, about how that incorporates into what happens when we actually file our taxes at the end of the year, because the amounts that are withheld during the year obviously that information is needed in order to then prepare tax returns come April, those Form 1040s. But just wanted to, we'll go ahead and watch this video. Gives you a little bit, probably says it a little bit better than I just did. Little bit of history about it. The income tax system is not very long. It's like a 5-minute video, but I thought that would give you a little bit of preview. And then we're gonna go into, we'll review, I recall I put up that table on the board. Last time we talked about the difference between those employer-provided fringe benefits, meaning the employer pays for them, and fringe benefits the employee pays for. And we kind of have two categories of those that are taxable. So if the employer is paying for it, the employee is going to pay tax on the value of that item. And then we have non-taxable employer-provided fringe benefits, and then we also have this concept of pre-tax and post-tax, and those are benefits that the employee pays for. So we're going to go through in a lot more detail those distinctions and how that affects the withholding. Okay, so we'll spend some time looking at that, as well as kind of getting an introduction. Oh, we're going to look at the W-4 form too. I'll tell you what that is when we get to that point. And then hopefully we might have some time maybe to start getting into the different withholding methods. If not, we've got time on Thursday to start getting into that as well. Okay, any questions before I start the video? Nope, okay. Let's see how loud this is.
Hey, so how did you feel when you received your first paycheck? I was pretty excited, I'll be honest. I worked for weeks and weeks, and there in the sealed envelope was my very first hard-earned compensation, and I had so many plans about what I was going to do with the money. But those hopes were brutally dashed the moment I read the bottom line. By the time the money actually got to me, it had been sliced up like a pizza. An alphabet soup of government agencies each got their cut before I did. But what are taxes anyway? How do they work, and how do we end up with this present system? First things first, the basic idea of taxation is pretty simple. There's some sort of state or similar authority that imposes a levy on an individual or a legal entity, like a corporation or something. If you can't pay, then you can be charged with a crime. This is a very old concept. It dates back as far as Mesopotamia and Egypt's Old Kingdom. Nowadays, the tax man's not going to beat the crap out of you for being late, but the system is way, way more complicated. In the United States, the taxes you pay vary from person to person, from company to company, from check to check, and then from state to state. However, most people do have to pay the federal income tax. And the U.S. tax system is huge. Complex doesn't even begin to describe it. A better word would be Byzantine, which I looked up earlier. In 1913, Congress passed the 16th Amendment, and the 16th Amendment says this specifically: the Congress shall have power to lay and collect taxes on incomes from whatever source derived, without apportionment among the several states, and without regard to any census or enumeration. Okay, let's be honest. While most folks in the U.S. only think about taxes when April approaches, the process really begins when you start a new job. You and your employer agree on your compensation or before tax income. Next thing you do is fill out a form called a W-4, and it determines how much income tax your employer will withhold from each check. Why do they do this? Good question. Employers are required by law to withhold income tax and deposit the money in a Federal Reserve Bank. And this is how the federal government maintains a steady stream of income, also drawing interest on your tax dollars. Pretty clever, huh? So instead of paying taxes once a year in April, you're actually paying them all year long, every time you get a paycheck. Now, the rules change when you're a freelancer or an independent contractor or you're otherwise self-employed. Nobody's going to withhold income taxes each time you get paid by a client or a customer, so it's up to you to manage what you owe. What's a good way to think of income taxes? Let's think of filing income taxes in April, kind of like settling up with the IRS. All you're doing is figuring out if you paid the right amount of cash. If you pay too much, boom, you get a refund. If you pay too little, boom, you're writing another check. Income tax forms like the 1040 are notoriously confusing, but that's because they're based on a code that's more than 5,000 pages long, because somebody thought that would be a good idea. Presidential candidates are always talking about revising the system. But how, right? Well, there are all sorts of potential alternatives, like, for example, this thing called the flat tax. Under a flat tax system, everybody pays the same rate. So proponents of a flat tax system say that it would do away with all the complicated codes and forms. Critics say this system favors the wealthy, and that's not the most controversial idea. There's another one. It's even more controversial than the flat tax, the idea that we should just repeal the 16th Amendment altogether, abolish income tax, don't worry about it. In place of income tax, then, they would have a national sales tax. So many countries around the world already levy a national sales tax. You've heard of it before. It's called a value-added tax, or VAT. The difference is that most of these countries also collect income tax. U.S. backers of this plan want to get rid of the IRS and charge a flat 10 to 25% on all retail purchases of new goods and services. So people who are fans of this say that a consumption tax collects revenue from everybody, even illegal residents, tax dodgers, tourists from other countries, etc. Opponents say that it puts an unfair burden on the middle and lower classes who buy a lot of the stuff that will be taxed. They also say it might reduce consumer spending, slowing the economy down. And then they add that in order for it to be fair, it would have to be applied to the purchase of stocks and bonds in addition to consumer goods. Yeah, so it's no secret that taxes are a bitter subject in many countries. And the United States has had at best, a rocky relationship with this issue. The U.S. doesn't just have one of the most complicated tax systems in the world, it also grows more complicated each year. This is a politically charged, divisive issue, but there is one thing that everyone can agree on. The current system is not perfect. So here's a question. What would you change if you were in charge? Let us know in the comments. Go ahead and like and subscribe. Thank you.
Okay, so a little bit of background there, very brief, about the tax system. So, questions, comments, anything before we get started? No? All right. So let's review again in a little bit more detail this whole concept, because we're going to be talking about all 4 of these items. We're going to start out talking about these employer-provided fringe benefits, and we already talked a little bit about that. These are items that the employer pays for, so the employee doesn't have to pay for them. Some of these items are taxable, and some of them, I gotta change that, should be non-exempt. Some of them are taxable, meaning that the value of the item is going to be added to taxable income before we calculate how much should be withheld. Some of them are non-taxable, which means we're not going to add them to our taxable wages. So for example, I hope this pen works. So if we have wages, of $1,000. Okay, we got 2 different wages. If we are talking about an item that is taxable, fringe, and non-taxable, let's say these are our wages. This is the cash that we're paid for our time or for our services. But in addition to this, our employer is providing us with health insurance. Okay, so our employer is paying for that health insurance on our behalf, and it costs $2,000. Okay? If that health insurance, by the way, is a non-taxable benefit. Okay? If it were taxable, that $200 would be added, and this is the amount that we would calculate the withholding on. If it's non-taxable, it's not added, and this is the amount that we're going to calculate the withholding on. So when we do the calculations, keep in mind that if we have any amounts that are, actually I shouldn't put health insurance over here. Let's put something that is taxable over here. Health club membership. Off-site, remember? Off-site. So the health club membership adds to our taxable income. The value of that $200, then we're going to calculate our tax withholding on. Health insurance does not add to our taxable income. So essentially we're getting something for free, right? I mean, really for free, because we're getting the benefit of the health insurance, but in addition, we don't have to pay tax on it. So when we're doing our calculations, we are going to start with taxable income. That may be different from our total wages. Okay? So we have to arrive at our taxable income here. So taxable, non-taxable. Then on the other side, we have items that are paid for by the employee, right? So that's an amount that is coming out of the paycheck of the employee. Some of those items are what we call pre-tax, meaning that we can subtract the value from our taxable income. Some of them are post-tax, which means we don't get to subtract the value from our taxable income. So if we have an item that is, let's say, we'll do pre-tax and post-tax. And we could have taxable items and non-taxable items. We could have pre-tax items and post-tax items on the same paycheck. Okay, so it's not, don't think of these in isolation. It could be that we have these items in conjunction. So for example, let's say we've got, in this case, we have the value of a health club membership, but at the same time, we are contributing to a retirement plan. The employee is contributing to a retirement plan, and each pay period, they have $100 withheld from their paycheck. That means now that our taxable amount is going to be reduced by this $100. So $1,100 is now then what we're going to use to calculate our taxable income. Okay, so again, what we're trying to arrive at here is the amount that is taxable. And you'll see when we go through these calculations, this is not the amount that the check is going to be. This is just our starting point for how we're going to calculate the tax. Okay, so retirement plan would be pre-tax, post-tax would be like a charitable contribution, which is, a lot of people will like contribute to United Way or something like that, and they have it taken directly out of their paycheck. Well, that's a post-tax deduction. $100 is being contributed to charity, but it's not going to affect our taxable amount here. Okay, so our taxable, in this case, would still be $1,000 because this is post-tax. This is not going to reduce our taxable income. Okay, so again, first step is we want to, this is all part of the process of calculating what our net paycheck is going to be, how much the employee actually receives in their pay. We have to start with how much of it is taxable in order to calculate what the tax is that will then be withheld from the paycheck. Okay, so I'm going to change that right now because that's going to bug me. This is taxable, non-exempt. Right, so not exempt from taxation, exempt from taxation. So on the let me pull up the PowerPoint here. Oh shoot, let's do that. We're gonna look at a list of exempt payments, some examples of amounts that are non-taxable, okay, amounts that the employer pays that are then not going to be taxed. So these are exempt payments, this category here. I think we are anyway. I can get it downloaded. Oh, it's up here. Okay, so, and this is not exclusive. This is just a list. I mean, this is a pretty long list that they've included here, but they're not, it's not exclusive. Advances. So if your employer wants to send you on a trip to a conference, and they issue you a check for $2,000, and they say you go and make the arrangements yourself, buy the plane ticket, book the hotel, all that stuff, and take it out of this $2,000. That advance is not taxable. As long as the employer has an accountable plan, that would not be considered taxable income because it is related to the work. So any of those amounts, as long as if the employee, let's say they get $2,000, but their expenses are $1,800, that $200 that doesn't cover the expenses that would be considered taxable income, okay? Because it's not related to that travel. Accident and health insurance payments. As I mentioned here, except 2% shareholder employees of S corporations, don't worry about that too much. That's getting a little bit into the weeds. But accident and health insurance premiums, so like here, health insurance was not taxable. So if the employer pays on behalf of the employee toward health insurance, then that is not considered taxable income to the employee. Deceased person's wages, believe it or not. So when somebody dies, that last paycheck that they may receive would go to the estate, not to the individual, and so that would be considered an exempt payment as well. Let's get through some of these other ones here. Oh, I want to talk about this one. Educational assistance. So payments up to $5,250 per year that are paid to an employee for tuition that is not job related, those are exempt payments. Now, if it starts to exceed $5,250 a year, then any amount over that would be considered taxable income. Or, if it's over $5,250 per year. Let's see. Business expense reimbursement. So before I talked about the advances, that's where they're giving the money to the employee before the trip actually takes place. Reimbursements would be the employee incurs the expense and then submits for a reimbursement of expenses that they have incurred. Those amounts, again, as long as it's part of an accountable plan, that would not be considered taxable income and would therefore be exempt. Let's see. Employer provided parking up to $280 a month. If the cost of the parking is over $280 a month, you're not going to find that really in Des Moines, but there are some big cities where you would find that, then that amount would be considered taxable if the employer pays for it, right? So any amount over that 280. What else? Group term life insurance. So we probably need to talk about this a little bit. Everybody knows what life insurance is. Life insurance is individuals pay premiums for this insurance that if they die then pays a benefit to whoever they've named as a beneficiary, to their survivors. Employers can provide that life insurance to employees, and the employee gets to choose who the beneficiary is, as long as the benefit, so the amount that would be paid if the employee died, is less than $50,000, then the premiums that are paid for that benefit are not taxable to the employee. However, if the benefit exceeds $50,000, then there's a calculation that has to be done to determine the amount of premium that applies to the benefit over $50,000, and that amount would be taxable to the employee. Okay, so it's kind of a complicated concept, and the calculation, so it's whatever portion of that premium is attributable to the benefit over $50,000. That would then be added as a taxable benefit to the employee's income. But again, that first $50,000 of premium is not taxable. Health reimbursement arrangements. So if an employer has a health reimbursement arrangement set up, that's kind of different from health insurance payments, but it's where the employer is paying for some health benefits for the employee. As long as they have this health reimbursement arrangement set up, then any of those reimbursements are not considered taxable to the employee as well. Long-term care insurance premiums up to certain amounts are also non-taxable again. So a lot of these have to do with insurance that is paid for the employee, for the benefit of the employee, but the premium for that insurance is paid for by the employer. Moving expense reimbursements. We talked about this a little bit. Only military members receive the benefit of it not being taxable. If your employer pays for you to move somewhere, then that amount is considered to be taxable income to you. What else here? Retirement and pension plans. Okay, so I mentioned retirement plan here. Retirement plans are going to cause you a little bit of consternation with your homework because they are treated differently for income tax purposes than they are for FICA tax purposes. So when you're doing your calculations, you're going to have to do a couple of different calculations. You're going to have to determine how much is taxable for income tax, how much is taxable for FICA tax. And retirement plans are one of those areas where there is a difference. So for retirement plans, they are pre-tax for federal income tax purposes, but they are not pre-tax, they are post-tax for FICA tax purposes. Okay, and again, this just giving you kind of a little preview. We will go through some of these calculations to help make it a little bit more clear for you. And again, that's the amount that the retirement plans are actually, I'm kind of getting ahead of myself here because I'm talking about pre-tax and post-tax. What they're referring to here with exempt payments are amounts that the employer pays on the employee's behalf. So any employer contributions are not considered taxable to the employee. Again, transportation, same limit as the parking. Here. All right. So those are just a brief list of amounts that would be exempt. So amounts that the employer pays on behalf of the employee, but the employee doesn't pay any tax on it. Okay, they're not assessed any tax. So let's talk a little bit about some of the pre-tax and post-tax items. So these again are these are items that the employee is going to pay, but it may or may not be subtracted from their taxable income. Cafeteria plans encompass benefits that are health related for the most part. Accident and health insurance, so medical insurance, self-insured medical reimbursement plan. There are some companies, and usually it's large companies, that instead of actually paying health insurance premiums to an insurance company, they will set aside actual funds that can then be drawn to pay for employees' medical expenses. If it's part of a cafeteria plan, then that is a pre-tax benefit. Group term life insurance is included in these cafeteria plans as well, which I already talked about here. Dependent care assistance. Okay, so dependent care assistance, this is an arrangement whereby employees can have amounts withheld from their paychecks, set aside, put into a savings account that then they can use to draw upon to pay for child care or care for any dependent, any qualifying dependent. So you have, let me kind of give an example here. These amounts are up to $5,000 a year is pre-tax. So for example, let's say we've got, again, wages of $1,000. And we have dependent care that is withheld from our paycheck of $100 each pay. Okay, so this amount is withheld. This is a pre-tax benefit, so this is our taxable amount. That $100, what happens with that $100 is that it gets deposited into a savings account. And now there's $100 in there that the employee can access to help pay for dependent care expenses. So if you have a child in daycare, you've got $100 set aside that can then help pay for those daycare expenses, okay? This, by removing it directly from the paycheck, it shields it from taxation. Now we're going to have lower income that is subject to income tax as a result of that. Does that make sense? So it's just setting it aside. There are other types of accounts as well called flex accounts. They're health savings accounts is another category of this where it gets set aside, put into a separate account. Flex accounts work the same way for health related expenses. So, and again, we'll go through in more detail those types of expenses. So any contributions that the employee makes to cafeteria plans, and a cafeteria plan, the employee can kind of pick and choose. I call it cafeteria, like when you go into a cafeteria, you got a bunch of different entrees and desserts and you do it all separately. Your sides are separate. So it's the same sort of concept. That's why they call it a cafeteria plan. You can pick and choose which benefits you want to take. The employee can. So any contributions that the employee makes to cafeteria plans are pre-tax. And these items here are included in these cafeteria plans. So health insurance, medical reimbursement plans, life insurance, dependent care assistance, health savings accounts. I mentioned the flex spending accounts. It's the same concept as the dependent care accounts. Employees can put up to, and this was in 2022, in 2023 I think it's $3,050, and it's going to go up again in 2024. So the employee can put up to this amount, $2,850, into this separate savings account, and then they can draw from that when they have medical expenses. So for like co-pays, I know I've got one of these, and I have my second child is going to get braces here pretty soon, and so I use those funds to help pay for the braces. Otherwise, I wouldn't get a tax benefit from it, right? But the fact that it's being taken out of my paycheck means that I'm now reducing my taxable income by the amount that I'm contributing. It's still my money. It's just shielding that money from being taxed, right? And so that's the dependent care works the same way. The flex care works the same way. Also health savings accounts, which are a specific type of benefit. They have health savings accounts. I think we go into health savings accounts in a little bit more detail later. We'll talk about those. They're different from these flex spending accounts. They have different limits, but they also have different requirements for them. Okay. Oh, I guess we're going to talk about it right here. So health savings accounts, as you notice, that flex account, again, the limit was $2,850. The limit for the amount that can be contributed to a health savings account is much higher. It's about $7,000 that can be contributed, and these contributions are on an annual basis, so every year. The flex accounts expire, meaning you can only, if you do not use the money that's in there, you lose the money. So you use it or lose it by a certain deadline. So you don't want to participate in one unless you know that you're going to use that money, because otherwise you're just throwing your money away. Health savings accounts never expire. They always are, individuals who own those always have access to those health savings accounts, even when they're not an employee anymore. Essentially it goes with them. I'm not going to really talk about the Archer medical savings accounts because they don't do too much with those anymore. Okay, retirement contributions. So before, when we talked about retirement, we talked about amounts that the employer pays. Where'd it go here? Somewhere in here. Educational assistance, retirement plans. Okay, so with regard to exempt payments, we're talking about amounts that the employer pays on behalf of the employee. Oftentimes with retirement accounts, the employer and the employee both contribute to those retirement accounts. So, and for private companies, they have plans called 401ks, and oftentimes there's what they call a match. So if the employer kind of like Social Security, where they'll share it. If the employee puts in, there's 401k, the employer puts in, let's say it's 100% match. So if the employee puts in $100, the employer's going to match it, and they're also going to put $100 in. And so this would be 100% match. They're not always 100% match. Sometimes they're 50% match. Sometimes they're 25% match. But it's always going to be based on a percentage of whatever the employee contributes. So that means in total, $200 is going into the retirement fund for the employee. For the employer, so this is an exempt payment, meaning it's not going to be taxable to the employee. For the employee, this is a pre-tax deduction, meaning they're going to shelter then that $100 from income tax. Okay, so this is exempt from federal income tax, Social Security, and Medicare tax. The amounts that the employer pays are exempt from those taxes. The amount that the employee pays is pre-tax for income taxes, but it is post-tax for FICA. So if you can imagine, remember when we did these calculations with regard to FICA taxes and calculating the taxable amount of income for with regard to FICA tax, we had an amount and we multiplied it by the 6.2% and the 1.45%. When we're doing these calculations, we would subtract, when we're calculating income tax, we're going to subtract this amount, but when we're calculating Social Security tax, we're not going to subtract that amount. Okay? We're on time here. Again, we'll go through some of those examples. Just kind of a preview. Let's see through that. All right, lots of different types of retirement plans out there. Like I said, a common one is a 401k where the employer will usually provide some sort of match, but there are lots of different kinds. So 401k, 403b is the same as a 401k, except it's for nonprofit organizations. 457b is, and these all refer to code sections in the IRS, the IRC, Internal Revenue Code. 457b, that's for governmental employees. Simple plans are usually for small businesses, but there is some sort of employee-employer match there. All right. Again, we're going to go through this stuff. When we go through, it'll become more clear once we go through a lot of the problems we're going to study. Okay. Let's switch gears a little bit and talk about the W-4 form. Any questions right now? And I know that's kind of a jumble at this point. Know that we're going to go through a bunch of problems, okay? That will help to, yeah.
When it's talking about the retirement plans,
Mm-hmm.
and it says at that point, subject to the federal income tax, is that like when they pull it out, like when they retire?
Can you read me the whole sentence?
It just says at the end of the contributions to tax-deferred retirement accounts are money set aside from current paychecks that will be paid out to employee upon retirement. So is it at retirement that it's subject to the
Yes.
federal? Okay.
Yes.
Okay.
So you are postponing the taxation on that income,
Okay.
essentially. But as long as it grows, retirement funds, of course, could, depending upon how they're invested, what you get at the end, hopefully it's grown in amount, but yes, once you actually withdraw it in retirement, then that's when it gets taxed. So it's tax deferred, not really tax free, right? It's, you're just putting it off for a certain period of time. Other questions? It's a good question, by the way. All right, so let's look at, the video talked about this W-4 form. So let's take a look at it and see what kind of information is on it. I'm sure several of you are aware, are familiar with this form. If you have a job, you should be familiar with this form. Let me make this a little bit bigger though. This is the employee's withholding certificate, otherwise known as the W-4. And every employee fills this out when they first get hired, and when their marital status changes, when they have a child, when they get divorced, when they have a child move out of the house and is no longer dependent, most life changes will trigger a new W-4 having to be filled out. And you'll see why here. The information that is needed on here pertains to what's going on in the person's life. So the first section, pretty simple, just name, address. This is the employee's name. Name, address. Next question on here, well, they've got to include their social security number. This next question on here is critical. This is filing status. Now, if you've ever filled out a tax return before, you'll know that one of the first questions on the tax return is, what is your filing status? Filing status always pertains to marital status. Okay, now you'll see that's kind of weird because you're either like married or not married, right? And yet we have 5 different filing statuses. Well, that's because human relationships are complicated, right? And so as a result, the tax code kind of reflects that. But these are, so the employee needs to know what their filing status is in order to fill this out. Now, as a payroll professional, you cannot advise somebody what their filing status is. If you go into the payroll profession and you have employees that come and say, hey, I don't know how to fill this out, can you help me fill it out? Aside from just the basic information of put your name and address here, indicate your filing status, answer all these questions, you really can't say much more. Because otherwise you're giving tax advice and you're not allowed to do that just as a payroll professional. So the answer with any specific questions is consult your tax advisor. And I would have as a tax preparer, when I was doing taxes, I would have a lot of clients who would come in and say, hey, I started a new job, I don't know how to fill this out. How do I fill this out so that it's most accurate? Because what the information that is provided on this form is going to give the employer information about how much to withhold from the paycheck. Okay? And how much to withhold from the paycheck directly affects the results on the Form 1040 that's filled out at the end of the year. So it's related to the preparation of that end of the year tax form. So here's our filing status choices. Now there are 3 boxes, but there are 5 filing statuses. First one is single or married filing separately. Single means you're not married. And the filing status is determined as of the last day of the year. What do I hear? Everything's vibrating. Awesome. So if you are single on the last day of the year, or you expect that you're going to still be single on the last day of the year, December 31st, not married, then you would indicate that you are single. That could be divorced, that could be never married, either one. Married filing separately means you're married, but you file a separate tax return from your spouse. Now, usually, spouses will file one tax return and combine all of their income and expenses on that single tax return. That filing status is called married filing jointly here. But they have the choice of filing on separate tax returns. Generally speaking, that is not an advantageous filing status. Usually people end up paying more in taxes when they file that way, but people have non-financial reasons for wanting to file that way. They may have financial reasons as well for wanting to file separately. Even though they're going to pay more in taxes, it may help save them elsewhere, right? I had some clients years ago, married couple, they had a child, and they had really big student loan debt. They were both professors. Really big student loan debt, and they were wanting to reduce their student loan payments because, you know, there's income-based repayment. Well, combined, their income was too high to affect their income-based repayment. But if they filed separately, then they would both be able to take advantage of some income-based repayment. Even though they ended up paying more in taxes, it lowered their student loan payments enough that it made it worth doing so. So like I said, there's some non-financial reasons for wanting to do that. Well, I mean, that was a financial reason. Non-financial reasons, if you don't trust your spouse, you're in the middle of a divorce, and you can't, you know, nobody's getting along, then that might be a situation for married filing separately. Married filing jointly, again, married couple, as of the end of the year, that have chosen to file together on one tax return, combining all of their income and all of their expenses together. Qualifying widow or widower, is a specific filing status where somebody who has lost a spouse, if they have a qualifying dependent for 2 years, the 2 years after their spouse's death, they may choose to file as a qualifying widow or widower. Essentially what it does is it gives them the benefits of filing as married filing jointly for a couple of years after that, as long as they don't get remarried, rather than filing as single, or as the last classification is head of household. Head of household is a single individual with a dependent. And I mean, there's more specific rules regarding that, but in general, you have to be unmarried. And they say here, they give you some of the qualifications. Unmarried, pay more than half of the cost of keeping up a home for yourself and a qualifying individual. So, you know, you might have, if you're a payroll professional, you may have somebody come in and say, hey, you know, I don't know, am I single or do I file as head of household? Ask your tax advisor. You know, you can't give them advice on which of those filing statuses to use. But you'll see when we go through the calculations that filing status is very important. It is going to change the amount that is withheld. So an individual who is single and has taxable wages of $1,000 is going to have a different withholding amount than somebody who is head of household with wages of $1,000, even if they're paid at the same frequency. Right, so it changes based upon filing status, but that's a critical piece of information that is provided there on the W-4. Step 2 here, so that's just step 1. Step 2 is completed if you have more than one job or you have a spouse that also works. And for our purposes, so there are a couple of different options for filling out this step 2. One option, and this is the hardest option, which not very many people actually use, is there is this estimator that is provided on the IRS website that you can go through and enter in all of your income information, all of your spouse's income information, all of your deductions. Essentially, it's like filling out a tax return. All of that information, and then it will pop out a number for you, and that's your withholding. Now, that's a little difficult if your wages vary from paycheck to paycheck. If you have a standard salary, that might work, but there is this estimator on the IRS website that can be used. There is also what's called the multiple jobs worksheet. Now on page 3, you'll see that this is several pages long here. There is a separate worksheet that could be filled out. And all of the instructions are there. I'm not going to read through all of them, but this is another way that could be used for an employee to calculate how much should be withheld. Now, what most people do though is use the third option, which is essentially check this box or don't check this box. So if there are only 2 jobs, you may check this box. Do the same on W4 for the other job. So this is accurate for jobs with similar pay. So you, for example, you're married, you make $50,000 a year, your spouse makes $55,000 a year. That's similar enough pay that all you have to do is check this box. This is what we're mainly going to use for our problems, is this checkbox. So, and you'll see when we go through, there are different factors that we have to know in order to calculate withholding. That checkbox is one of the factors, okay? There are 4 factors that we need to know. 4 factors in most cases that we need to know. In order to calculate withholding, that checkbox is always one of those factors. Step 3, so does everybody get that? Now, step 2 is if you've got more than one job. If you don't have more than one job, then you can just skip step 2. And it says here, complete steps 2 through 4 only if they apply to you. Well, if you have more than one job, married, filing jointly, and your spouse also works, then you fill this out. If you don't, you just have one job and you're single, or you just have one job and you're head of household, then you don't have to fill that part out, okay? You'll see in your homework problems, it will indicate whether or not the checkbox was checked or the checkbox wasn't checked. Again, this is the checkbox that they are referring to in those problems. Okay, step 3, claim dependents. So if you have, and again, as a payroll professional, you cannot define for somebody what a dependent is or tell them, yes, this is a dependent, you know, that your child is a dependent, or no, your child is not a dependent. Again, the answer is for those questions is always check with your tax advisor. Most people, they will know if they have dependents. Sometimes they may be wrong, but it's not the payroll professional's job to do their taxes for them, right? You're just there to process their paychecks based on the information they give you. So, step 3 pertains to a couple of different tax credits that are on the individual income tax form. The child tax credit and the credit for other dependents. So, and some of you may be familiar with some of these credits. The child tax credit gives individuals, qualifying individuals, $2,000 tax credit. That means essentially $2,000 off their taxes for each qualifying child. Okay, those qualifying children have to be under the age of 17. So if you've got 3 children under the age of 17 and they all qualify for the child tax credit, boom, your taxes were just reduced by $6,000. That is reflected on the W-4 because we want to bring that withholding down to accurately, so we're withholding an accurate amount. Now, employees don't have to claim this if they don't want to. If they are qualified, if they have a qualifying dependent and they don't claim it, it means they're going to be over withheld. They're going to have more withheld. The IRS really doesn't have a problem with people having more withheld than they need to. They do have a problem with employees having less withheld than they need to, right? If you're lending the IRS interest-free money, they're not gonna argue with you about that, right? They are gonna argue if it's the other way around. So, but usually people will, when they have qualified dependents, they will fill this out. So, under age 17, $2,000 per dependent. 3 kids, that would be $6,000. If they are a qualifying dependent that is not under age 17, then they may qualify for this credit for other dependents, which is $500 a piece. So obviously the child tax credit is more valuable, $2,000 for each child, but $500 still is nothing, nothing to sniff at. All of that is added up then and entered on line 3. So all they're doing here is multiply the number of qualifying children under the age of 17 by 2,000, multiply the number of dependents by 500. These are not the same people. Yeah.
So
So say that one more time, sorry.
So when are 17-year-olds included in like?
Because that's just the tax law cutoff to benefit from the child tax credit. For a couple of years, it was higher than that because of COVID. Yeah,
So like what if the 18-year-old was still in school and they like actually?
yeah, no, they don't qualify. That is a hard cutoff, regardless of what that child is doing. Even if they're still dependent on you, then what happens is now you qualify for this $500 instead of the $2,000. Yeah, during COVID, they changed that. I think they changed it to, I can't remember exactly if it was 18 or 21, what they changed it to, but it was raised for a couple of years, but then it was brought back down to under the age of 17. And that's under the age of 17 as of December 31st. Okay, so if you have a child that turns 17 on December 31st, you're out of luck for that whole year. So again, this pertains then to the number of dependents. Now, step 4, as they say here, it's optional or other types of deductions. Remember, the whole purpose of this is to try to calculate as accurately as possible on a per paycheck basis how much is going to be owed on that end of the year tax return. Okay, so that's why there's all these questions about it. Other income, not from jobs. So if you have, remember, interest income, dividend income, capital gains, other types of rental income, other types of income, we usually don't have withholding on those other types of income. But the W-4 gives individuals with that type of income the option to have withholding from their paycheck to help to mitigate that, right? So maybe they've got rental income of $12,000 a year, and they don't have any withholding on it, and they don't want to make quarterly estimated payments. They could instead have the tax on that $12,000 withheld from their paycheck. Right? So it still pays for it. Same with interest, dividends, all other types of income. You can add that in there. Deductions. So this pertains again to the income tax form. And it asks about, it says, if you expect to claim deductions other than the standard deduction. So real quick, there are a couple of types of deductions that individuals can claim, which a deduction is going to reduce the amount of taxable income. One is a standard deduction. The deduction amount is based on filing status. Another is itemized deductions. So these are a list of specific deductions that individuals may qualify for, and they get to take either one. Whichever one is higher, they take the standard deduction or the itemized deduction. So your standard deduction is $12,000. Your itemized deductions are $14,000. You will take the itemized deductions because you're going to get a bigger tax benefit. If that's the case, if individuals claim itemized deductions, then they can enter that into the calculation, and obviously that's going to reduce their withholding because that's an additional expense. And then if they want just any other extra amount of withholding. So you go through all of this and you're like, I just don't think it's going to be enough. I think I'm going to end up owing $1,200 at the end of the year. And I get paid on a monthly basis. Okay, take an extra $100 out, right? Just to be sure. So there is that spot for extra withholding. Very last part here, it's just a signature. Okay, there are some worksheets as a part of this. We looked at one of them. There's that multiple jobs worksheet. There is the deductions worksheet. So if the individual is itemizing what we just talked about, they can fill out this worksheet to determine how much to enter into that box. We'll talk about this stuff, start talking about this on Thursday. But that gives you, that's pretty much the rundown on the W-4 form. So you're going to become really familiar with this because, again, it's information on this form that is needed in order to calculate the income tax withholding. Okay? You guys are free to go. So on Thursday, we'll start those calculations.